Berkshire Hathaway is an old, boring company in this age of AI, and a lot of people kind of find it boring. They don't find it exciting. They have a lot of cash. Maybe they can't deploy all this cash, and the size is kind of against it. But I believe there's a lot of hidden value within Berkshire, and I'm personally getting very interested in potentially owning the company. I'm going to be doing a deeper dive on their businesses today, and I'm going to give you my fair value and how Berkshire could potentially be one of the biggest beneficiaries of AI. And I know it's very hard to believe it, but I'm going to talk about it in today's video. And I really hope you enjoy it as always. But the new CEO of Berkshire has shown a lot of confidence. He started repurchasing shares as of yesterday for the first time since May of 2024. So he's seeing a lot of value, and he purchased $15 million from his own money after his salary. He just put it into Berkshire. It wasn't stock-based compensation. It wasn't anything crazy. And that's really amazing to have the leader, or you should say the CEO and the management team, have the same incentives as the shareholders. And incentives drives the outcome. So this is really amazing over here. Now, Berkshire Hathaway makes money in many different ways. The first one is insurance. Insurance is by far the biggest one. And the biggest advantage of Berkshire Hathaway is the insurance float. This is what has led to Buffett's, you could say, very high return within the company. And the float is mainly whenever you pay your premium to the insurance company. The insurance company is going to hold the premium. They're not going to give it back to you until something bad happened. You have an accident, you have something crazy happen. Then they have to give you the premium back. So it could be 5, 10, 15 years before they have to give you the premium back. So they're sitting on all this cash that's called the float. Most companies, they just sit on it. Buffett and Berkshire Hathaway, they invested in dividend stocks, they invested in treasuries, they invested in annuities and a lot of, you could say, dividend or safer high generating assets in general. And that leads to massive, massive return. And this is basically an interest-free loan. They're paying 0% on this money, but they get to collect 5 or 4 or 3% on it. And that's absolutely amazing. And as of the last quarter, the float on Berkshire Hathaway's Geico or insurance division was $176 billion. $176 billion. This is absolutely mind-blowing. Most of the investment income is generated by interest and mainly from treasuries, about $10 billion. Then they have dividends, which are generating $5 billion. Now, the risk over here is what if the Fed cuts interest rates? And they will be cutting interest rates. Berkshire will collect less interest on those treasuries. If rates go from 4.5% to 2.5%, it could pretty much be cut down by 50%. So this is the biggest risk to the insurance business of Berkshire and insurance companies in general, but it's still an amazing business where they get this interest-free loan and they can invest it in whatever they want and generate massive, massive returns. The second part of Berkshire, which is BHE, Berkshire Hathaway Energy, this is by far the most underrated part of Berkshire. They have like 21,000 miles of pipelines and a lot of the grid and a lot of utility-related assets. And those are very, very valuable assets, especially in the age of AI, where electricity is making everything much more expensive. I have a stock called Constellation Energy, the stock, and many utility companies have been going up a lot due to the rising electricity prices from the consumptions of AI data centers. But that's really not priced in Berkshire Hathaway, as BHE, which is mainly the pipeline holding company, it transports approximately 14% of the natural gas consumed in the United States. So this is a critical asset for national security, and you could see how resilient it is, where 14% of the entire natural gas supply in the United States is transported through Berkshire. Most people don't actually know that, and I did a deep dive, and I found this very, very interesting. So this is an amazing business within Berkshire Hathaway. Now, unfortunately, it hasn't really been growing over the last 3 years. It has been pretty much flat, but the time to and the opportunity to grow the business might finally be here. And the CEO talked about it during the annual report. He said near-term opportunities are significant and BHE will pursue them selectively. And of course, they're significant when you have all the data centers that are coming up and when you have a friendlier administration on building new power plants. So the business can finally grow, they can put up the capex to work. And I think it could be an amazing business within Berkshire. Now, unfortunately, most of it is through wind and the current administration is, you could say, against wind in general and renewables. They have natural gas and coal, which a little bit friendlier to the government, but the wind is not the best one, and it's not the most efficient one, you could say. But this is by far their largest segment. But they have other segments as well, and they've been recently expanding into nuclear. Now, the second biggest business of Berkshire is BNSF, which is mainly the railroad company. This is another high competitive mode kind of stock, and they have a massive railway all from California into Texas and many different places, and all the way down to Mexico even. I believe they own a percentage of the Mexican railway, Ferromex. So that's a really amazing part of the company. BNSF has actually been growing from 5 billion, recently $5.4 billion in net earnings. So that has been improving. And this is a really good part of Berkshire Hathaway. Now, something else that I didn't know about the company, mainly through the manufacturing segment where they manufacture products and other kind of things, is they own a piece of a company, or actually the whole company, called Precision Castpart. And Precision Castpart makes a lot of, you could say, critical components that are being used in those data center kind of power generation, and mainly in the natural gas fleet. Most of those companies like GE Vernova and Bloom Energy, they use a lot of parts for those turbines made by Caspart, which is something that I really didn't know. And this business has been growing really, really well. And they also make aircraft engine components and other kind of components. So those are critical sectors. And that's an amazing way to get exposure to that. And of course, they have the investment kind of portfolio is very concentrated. About 40% of the fund is mainly in Apple, AMX, which I'm not a big fan of, Coca-Cola, Moody's. So they're very concentrated, and I believe they want to keep it this way. Now, my favorite part about the investment portfolio is the bets they made in Japan when they acquired pretty much a 10% stake in each of the 5 largest trading houses. And the way Buffett did it is he didn't actually use the capital at Berkshire. He went into Japan and he borrowed money at back then was very low interest rates, about 1.2%. And then he used the money to buy a stake into those companies. And those companies were paying back then like 8 or 9% yield. So he pretty much got paid 6% to own them, and he got the capital appreciation for free. It was an amazing bet. And the maturity on it is 5.7 years. So they still have a few years left. Maybe by then the rates in Japan would be lower and they can refinance. But it was really a genius bet from Warren Buffett in general. Now, looking at everything together, they have $373 billion in cash and T-bills. Equity is $274 billion, which leaves you for the operating businesses about $570 billion. And those operating businesses are generating about $44 billion. This is the preferred metric of Warren Buffett, which is operating earnings. As operating earnings strips away any gains and capital appreciation from the stock portfolio, it tells you what kind of a yield and what kind of cash flows those operating businesses are generating. In this case, they're generating $44 billion, which was below $47 billion last year, but still higher the 5-year average of $37 billion. With Berkshire, it's not much about growing the operating businesses. It's about the cash flow coming in for them to do acquisitions and for them to reinvest the money in a very smart way. So $44 billion is amazing. But if we look at the total portfolio, the biggest problem with Berkshire, you could say it's mainly its size, because they have $373 billion. Yes, they can buy back some of the stock. That helps a little bit. They put it in T-bills. If interest rates go down by 50%, and they could very well go down by 50%, their treasury income will get cut by 50%. So what are they going to do with the money? They can't acquire another railroad in the United States without triggering the FTC on some kind of a monopolistic accusation. They can't acquire another insurance company because they have Geico. They have a lot of the dominant businesses. They can't acquire more of the big companies in Japan because maybe that also could trigger some kind of laws over there within the monopolistic laws. And what are they going to do with the cash? So that's really You could say that's really a big concern with Berkshire, where yes, it's undervalued. Yes, they have the money, but what are they going to do with the money? They're not going to be paying dividends. No way. Maybe they do buybacks, but whenever interest rates come down, that's going to affect the insurance business and the cash generation on the treasuries in general. Now, looking at the valuation of Berkshire Hathaway, it's trading at 1.4 times book value per share. Warren Buffett, he previously mentioned that he likes the stock. He around 1.2 to 1.3 times book value per share, which would be a little bit lower. But I'm surprised that the CEO has purchased stock at 1.4 times book value per share, while Warren Buffett used to buy the stock at 1.2 and 1.3 times. Now, if you look at this chart, the stock has a history of bottoming out around 1.3 times book value per share, 1.2 to 1.3. Anytime it goes to 1.3, it doesn't really stay there for too long, and it could potentially happen again. But for me personally, I believe Berkshire Hathaway is undervalued. I'm not going to try to value the stock based on different businesses because you need to put in a conglomerate discount, but you're paying about 12 times the operating earnings, and you're getting the treasuries, and you're getting a lot of potential upside from the utility company growing due to AI demand, the manufacturing component related to AI, and even the insurance business has a lot of employees and a lot of customer service and potentially underwriting could be monetized by AI, and it could be automated in general. So I believe the stock over here is kind of fairly valued. I mean, it's, you could say, undervalued, but for me, like the real bargain or a generational buying opportunity, I would like to call it, is mainly around $440 per share. That would be around 1.2 times book value. This is where Warren Buffett used to buy the stock. But again, a new CEO bought the stock today and the stock's going up, so we might not get it. But for me personally, I have a price alert set at 440. If it gets to 440 or anywhere close, it would be hard to lose money, and I would likely be buying Berkshire Hathaway, but I might even buy it today. I just haven't bought it because there's so many good stocks that are coming down, and I'm just, I've been holding on it. But that's my opinion on Berkshire Hathaway. Hope you enjoyed it. If you'd like more of such videos, let me know down in the comments. So thank you for watching again, and I'll talk to you in another video.